Welcome to Capital Link's company presentation series.
Good day to everybody. I am Nicholas Bornelius, President of Capital Link, and I would like to welcome you to Capital Link's Corporate Presentation Series 2024. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We have with us today the senior management of EuroDry, Mr. Aristides Pittas, Chairman and CEO, and Mr. Aslidis, Treasurer and CFO. EuroDry, as you can see, is listed on NASDAQ under the symbol EDRY. It's a dry bulk company and has currently a fleet of 13 vessels, dry bulk vessels. In terms of logistics, I would like to remind everybody that we have a presentation followed by a Q&A. Webinar participants can submit their questions anytime during the presentation, and Aristides and Tassos will reply to them after their presentation is over. In terms of the disclaimer, to remind you that this presentation today is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Tassos very correctly put also the forward-looking statement disclaimer. And of course, Capital Link bears no responsibility for the content. Now let's begin, and I will turn the floor over to Aristides and Tassos.
Thank you, Nicholas. Thank you for organizing another interesting presentation for us. We hope that we will be able to give a clear picture of the company to the participants. Tassos will go over a quick presentation, and then we will be able to answer any questions that we will receive. So please come in with any questions you have. Send them to here, and we will try to reply. Tassos, go ahead.
Thank you, Aristides. Thank you, Nicholas. Good morning to everybody from me as well. As Aristides mentioned, I'll take the next 15 minutes or so to give you an overview both of our segment and of EuroDry, our company. And let's start by saying that EuroDry is a rather new company. It has been spun off from Euroseas almost 6 years ago, back in May 2018, to contain the dry bulk interest of Euroseas at the time and provide a pure investment alternative to investors and our shareholders. We are focusing in providing worldwide ocean-going transportation services for dry bulk commodities, which are the major bulks, iron ore, coal, grains, and minor bulks, mainly steel products, but quite a number of additional commodities. One thing that would characterize EuroDry is that we focus in the middle of the size range of dry bulk carriers. We have vessels from about 1558, to be exact, 1,000 deadweight tons to 85,000 deadweight tons, because we believe that this size range, this segment of the fleet, presents the most flexible employment opportunities. We currently own 13 vessels, having an average age of 13.5 years and a carrying capacity of a little more than 900,000 deadweight tons. Although EuroDry is a young company, our former parent, Euroseas, was formed almost 20 years ago by Aristides, but the family of whom has a very long presence in shipping. The roots of the family date back to the 19th century, about or more than 150 years ago. Euroseas, our former parent, accessed the capital markets in 2005 and has been listed on NASDAQ since 2007. We have been listed on NASDAQ since inception in 2018. All the management of EuroDry, myself, Aristides, our Chief Administrative Officer, Simos, all have long experience in shipping, but also our board members have all leading positions in their respective industries and long-time investment experience in shipping. We manage our ships through an affiliate through two affiliate management companies, EuroBulk and EuroBulk Far East, founded in 1995 and 2015, respectively, both established and well respected within the industry, mainly for their efficient and safe operating track record. Our group, you can say it's a vertically integrated group. Through EuroBulk and EuroBulk Far East, we provide for all services a modern shipping company needs. Shipping, as you know, is a very volatile industry, very cyclical, and there is no better way to start reviewing our segment than by trying to figure out our position in the shipping cycle. I have a slide here that I think captures where we are right now. This slide has a couple of pieces of information. First, in the blue line, it shows the evolution of the charter rates, 1 year charter rates for a typical dry bulk vessel, a Panamax. And as you can see, indeed, our sector is very cyclical. We had some extraordinary peaks about 15 years ago, and since we have been, again, following cycles in the market, most recently, we had a significant rebound of the market coinciding with the pandemic years. We can get into the reasons, but primarily because of the tightness of the supply during that period, we had a significant increase in the charter rates that lasted about 2 years. In 2023, the market corrected and has returned around its historical median line. It has rebounded, as we will see also a little later, during the fourth quarter of last year and in January this year as well. The other piece of information that this slide shows is the red line, and the red line shows the amount of vessels that are under construction at different points of time. And it shows that number as a ratio to the existing fleet. What I think is noteworthy is for the last 4 years, since 2020, that ratio has been the lowest over the last 20 years. So it has reached about 8% back in at the end of 2020 and has stayed between 8 and 9% for the last 4 years. This level of order book is well below the order book required to replace the fleet. So we think that there is a supply squeeze being developed because of the under-ordering over the last 4 years. To complete our view about the market cycle, I have another slide here that shows how prices have fluctuated, including new building prices, and they have fluctuated very similar with the rates. They recovered during the pandemic years, and right now they stand a little bit above their historical median, the second-hand prices, potentially creating investment opportunities if the supply squeeze, as we discussed, and the tightness of the market develops. Let's talk a little more about supply, and because I cannot underline, I believe, enough how important that point is. This shows the expected fleet growth over the next 2 years in the little red circle that I have here on the top half of the slide, and of course also shows the historical development of the dry bulk fleet. But in 2024 and 2025, based on data from Clarkson, we expect to have 2 very low fleet growth years. At the same time, the dry bulk fleet profile, age-wise, is an interesting one. It has quite a concentration of vessels in the middle range of ages. There is about, in the bottom left part of the slide, you can see that there is about 40% of the fleet concentrated around in the group 10 to 14 years of age, but there is also 8% of vessels in excess of 20 years old, and those vessels are potential candidates for removal from the fleet, either because of their aging or because of difficulty of trading due to the increased environmental regulations. So the supply picture is very supportive of for the dry bulk market over the next couple of years. Switching quickly to the demand side, which is the other half of the equation, demand growth for dry bulk vessels is primarily a function of increases in dry bulk trade, and that in turn is linked to economic activity worldwide, but especially for dry bulk in China, because China provides the majority of the trade growth for the last 10-15 years. This chart that I have in the middle of the slide, at least visually, sort of proves or provides a sense of the correlation of dry bulk trade's connection to the world economic growth. But not only that, in addition to that, the dry bulk trade growth is affected by a number of other factors. An important one is changes or shifts in the use of dry bulk commodities. Right now, we're trying to shift away from fossil fuels like steam coal, and that has not been reflected yet, but is expected to be reflected in the trade growth figures over the next several years. Also, demand is affected by the routes over which the trade moves, and definitely the recent geopolitical developments, both in the war between Ukraine and Russia and the recent hostilities around the Red Sea and Gulf of Eden, have affected the typical routes of dry bulk trade, and in general led to higher demand for vessels. Additional reasons that would affect demand for ships are canal and port restrictions. We had congestions in the Panama Canal recently, and as I mentioned, issues with the Suez Canal. And yet, even more, we could have vessel speed-related factors. The effort to decarbonize and reduce emissions, an easy way to achieve that is by reducing the speed at which the vessels go, and reducing the speed essentially reduces the available supply of vessels. So there's quite a number of factors that could lead to demand development and demand growth. Summarizing all these factors together, we can say that the dry bulk market, after having a pretty soft 2023, in the fourth quarter of last year, experienced significant gains with Panamax, which is the index that we mostly track, exceeding $17,000 per day in December, and providing potentially a basis for a solid market in 2024. And in 2024, that solid market will be achieved if supply tightens, as we started discussing a couple of slides ago, and if demand demonstrates some resilience in growth. And as we have seen in the past, the supply-demand balance creates the changes and increases in the dry bulk rates. Reiterating the main theme of our investment thesis is that supply is limited. New orders have been sparse compared to the past, mainly because of the uncertainty and the lack of clarity of the fuel of the future, and thus have created a situation that could provide the foundation for a squeeze over the next 2 to 3 years. On the demand side, I mentioned, and I will mention it again, the key area to watch is China and the overall GDP growth in developed economies. And of course, the black swan events, if you want, squeezes around the Panama Canal, disruptions and the like. So that paints the picture of the segment. And let me now switch and talk a little bit about EuroDry. As I mentioned in the very beginning, we have a fleet of 13 vessels with an average age of a little more than 13 years. We tend to think of our fleet in 2 clusters, what we call modern new building cluster, which comprises of 8 vessels, all built in the last 10 years. 3 of those were built actually by us, and then 3 more were sisters of one ship that we ourselves built. We're built in the same yard about the same time. All of these vessels, we call them modern. They are eco vessels. They have been designed with lower fuel consumption than the previous vintage of ships. Our other cluster is our Panamax fleet that consists of 5 vessels, about 20 years old on average, Japanese built, so high quality ships. They have been the workhorses of the industry. Have been providing us historically with good earnings, and they could be cash cows if the market recovers modestly. Of our 13 ships, 3 were bought in the fourth quarter of 2023. Those are the 3 Ultramaxes that were sisters of the vessel that we built ourselves that I mentioned. What is noteworthy about this acquisition is that 2 of those 3 vessels, we bought them in joint venture with outside investors. Christos K and Maria are owned 61% by us and 39% by third-party investors. The vessels are fully consolidated in our financials, but are partly owned by our partners. We believe this type of joint ventures can provide us with a new source for growth. We're able to grow a bit more by having partners in our new acquisitions, and that we consider beneficial to our shareholders because these partners invest at NAV without us needing to issue shares below that level and thus diluting our shareholders. This model could provide another way for us growing, and we have established good relationships in Northern European markets, private markets, and we have potential to repeat similar transactions at opportune times with if interesting opportunities appear themselves. I'll spend another minute on giving you a glimpse of how we employ our ships. You can see on this slide that our ships are mostly employed on short-term charters in the spot market. Even a couple of our ships that have longer-term charter arrangements, the rate of those arrangements is linked to a spot market index. So we have positioned our fleet to be exposed to the market with the idea to take advantage of potential increases that we expect of the market in the coming years. Let me also say a quick look about our financials for 2023. I will use the 9-month figures that are public. For the first 9 months of 2023, we had total net revenues of about 32 million. We did lose money in the first 9 months because the market was lower. We had an average time charter equivalent rate of about $11,600 per vessel per day. That resulted us in losing about $1.17 per share. Adjusted EBITDA was about 8 million. And we used some of our funds during this first 9 months to buy back, because we thought our stock traded at a significant discount, to buy back about 4% of the company, spending almost $1.8 million. Opposite to the first 9 months of 2023, the fourth quarter has shaped better because the market recovered, and 2024 seems to be quite promising. The forward market for 2024, based on the Panamax index that we track, is around $14,500 per day, and that translates for our ships to about $15,000 per day on average. If, of course, this projection materialize, we should record a profitable year in 2024. A couple more points, financial highlights from our balance sheet. We had, as of the end of last year, a debt of about $105 million against what we estimate vessel value of $240 million. So a relatively low leverage ratio of about 44%. A good part of our loans are covered by the scrap value of our fleet. And our cash flow break-even, looking forward, looking for the next to the next 12 months, is a little more than $12,000 per day. If, as I mentioned in the previous slide, as the indices, the forward indices project the market is in the mid-teens, we should expect to have significant contributions to our bottom line. Let me close my remarks and open the floor for questions by highlighting why EuroDry is interesting. There are many reasons. I'll focus on the top three that I believe are the most important. One thing is that there are strong industry fundamentals. In the dry bulk market, there is a rare squeeze of supply developing, which we should, as investors, take advantage of. Second, for EuroDry specifically, we're a small company. I think balance sheet and cash position, and that would allow us to take advantage of market opportunities. Thirdly, and most importantly, I believe we are very attractively valued. We trade at $20 to $20 per share right now, which represents a more than 50% discount to our net asset value, although our price has indeed increased by about 25% over the last 12 months. So for these three main reasons, I believe it's worth for investors to look at EuroDry and its potential. There are quite a host of other reasons. I will not repeat them. I have gone through them during the presentations, but I think we present us and the sector an interesting investment alternative. With that, Aristides, should we open the floor for questions, or should we take some questions?
Yes, let's take some questions. I can see already some questions here on the Q&A section. So I'll start answering them as I see them. First question, at what level of charter rates do you intend to lock in longer-term contracts, if available? Yes, our strategy is, when markets are high, to fix up to 50% of our employment. We always want to have some open exposure, except if we will have a very strong view that the market is going to correct. We might go beyond the 50%. But if the market goes up to, let's say, 15,000 for a Panamax vessel, which is a level which is highly profitable, we would take some cover going forward for a few ships. Do you intend to use the joint venture investment model more? Yes, we like that way of growing the company. We know that EuroDry is still a relatively small company for public market purposes, not for any other purpose. I have to repeat that all the time. We are equally competitive with the much bigger companies. Our OPEX are similar to them, and what we get in the market, the charter rates are similar to what the companies with 100 ships get. So, but for a publicly listed company, we are relatively small, and we want to grow the company further. The joint venture investment model, which we're doing, I think is going to help a lot, and we will continue working on that. Would your share repurchase plan continue? Yes, it will continue. Again, because of the small size of the company, the low liquidity in the company, we are a little bit careful not to overdo it. And we always have to balance the amount of money that we pay out for repurchase with the growth opportunities. But having said that, I mentioned again that our family controls more than 50%, close to 55% of the company stock, and we are definitely not sellers. So the liquidity is a little bit low. It's a concern, but yes, it's so enticing to be buying our company when we're trading at below 50% of the NAV. Next question, do you expect to acquire more vessels in 2024? The answer is yes, without putting our balance sheet into any stress. And we are open in the market to perhaps do a couple more acquisitions within the year. Next question. It's great that you're doing buybacks at the current large discount to NAV. Would you consider accelerating the buyback through a tender offer? No, we will not do a tender offer. We will continue buying stock through the buybacks. I discussed before that the liquidity is relatively low in the company, and we have to address that matter as well. What is your plan with the older ships? When do you plan on selling, scrapping? Could those funds be used to accelerate the buybacks? We think that there is a significant value in the older ships, I have to say. It's an option that if what we think might happen happens, these elder ships can provide very significant cash flows for the company. So as long as the ships are maintained in a very good condition and the market is good enough, we will continue to utilize those ships. They might be very helpful in the future and help the company. Would you discuss how activity in the Red Sea is affecting the demand and charter rates for EuroDry's fleet? Well, sure, the Red Sea, the passing through the Suez Canal is a business that absorbs about 6%, used to absorb about 6% of the dry bulk trade. So 6% of the dry bulk trade went through the Red Sea up till recently. Now that has fallen by 30%, so it's just 4% going through the Suez Canal. So it is having an effect, but it's not huge, but it is having an effect. And I think that's why we are seeing the market remaining relatively strong during this first quarter, because traditionally Q1 is a very slow quarter, everything else being equal. This quarter rates are holding much better than what we anticipated before these events. And part of it has to do with the Suez Canal and the Red Sea issues. Another question. Bulk carriers on the Great Lakes have a conveyor system and boom to unload their cargoes, hence the name self-unloaders. Do you see your company using that technology? I believe these ships can unload their cargoes at about 5,000 tons per hour. Yes, this system is mainly on smaller vessels. The Great Lakes vessels are handy-sized vessels, and this conveyor system helps and assists in the faster discharge of the cargo. For bigger vessels, Ultramaxes and Kamsarmaxes, most of the ports that we go have their own discharging equipment, which is even faster than the 5,000 tons per hour that is mentioned here. So it's not something that is used in the larger ships, and we don't anticipate of installing any such technology. Do you anticipating locking charter rates for longer terms if pricing improves? I think I answered that question. Yes, if we move at charter rates for Panamax vessels above 15,000 per day. What are some unique cargoes your ships have carried in the last year versus the type of cargoes you listed in your presentation? I don't remember all the cargoes that we have carried, but it's the usual cargoes, coal, grains, fertilizers. I really don't have any specific cargo in mind to mention here. Have you received any offers to sell the company? That's a good question. No, the truth is we have not received any such offer for selling the company. And the intention is really not to sell the company, but to continue growing the company. Dry bulk is not being diverted from Suez, containers and tankers only, as far as I know. I answered that again. I think there is a 30% reduction in what is passing through Suez right now from dry bulk vessels. It's much bigger, as you rightly say here, on containers and tankers. Next question. 2023 trade was supported by China. However, it's difficult to anticipate further upside to iron ore and coal imports into China. In that case, where will the trade growth come from in 2024? Well, Clarksons predicts a slightly higher trade growth within 2024, and the developing Far East is an area, the other countries surrounding China, where we expect to have significant growth. China don't count it off yet. I mean, they are having the problems which we all know, but they are taking measures to strengthen their economy, and usually they are successful. So I wouldn't underestimate the potentiality of China also contributing. New ships, when buying second-hand bunker fuel or going with methanol, ammonia, or other propulsion systems, we are not really aggressive in trying to guess what the future fuel will be. So we haven't been active in looking at new buildings with methanol or ammonia or other propulsion systems, as you mentioned here in the question. We will wait to see which technology wins and invest accordingly. What we are doing, though, is that all the ships that we have been buying, and you saw the last 3 Ultramaxes that we bought 2 or 3 months ago, they are all very efficient vessels. So we're buying existing technology, but the more efficient, modern existing technology. Do you have any plans in expanding, operating in Mexico when you take delivery of your new vessels in 20? I think that was a question for Euroseas, not EuroDry. We're not taking any new building deliveries right now, and I think that was a question for the container company, so I'll skip it. Regarding the joint venture, it was mentioned that time charter rates are same for all vessels. Then why to get into JVs? Is it not better to own 100% of one vessel against, say, 2 vessels in JV? This will give full control and flexibility over the vessel. Well, we own 60% of the vessels, so we still have full control over the vessels and how they are employed, and we continue to manage them themselves. And it is helping the company be larger and look at more opportunities. It is also helping us access the investors in Norway that have taken this 40% of the company, and it's quite a few Norwegian investors who are looking into EuroDry, getting more familiar with it, and can potentially decide to invest also in common equity in the company. So I think this is a very good way of growing the company, getting more investors involved, and I'm sure it will have positive results as we go by. Do you have any intention to execute selling FFA to hedge or cover some open long positions? This is something that we do. We use FFAs to hedge positions. We use FFAs to hedge positions as we do longer term time charters, whatever makes more sense at the various points in the market that we feel it would be a good idea to hedge further. Yes, we will continue doing that. What is your plan to address the liquidity in your stock? This is a very good question. We hope, and this is one of the reasons we have not been more aggressive on the buybacks that somebody asked before. We would like the liquidity to increase. It's through awareness to the various investors, raising awareness through roadshows, through presentations as of today, that we hope that we will be able to raise the liquidity through the joint venture with the Norwegians. So we have these investors looking into the company. All these are ways we are trying to use in order to address the liquidity issue, to have more investors looking into us. So wondering if you have any view on how long can last current situation in the Red Sea. Well, it's very difficult to make a forecast here for how long this will last. Our base case is that it will not last too long. It will be, within 2024, the issue will be resolved. Now, when and how is a very difficult thing, and then it might not happen, as I'm saying. So I don't know more than any of you guys do. What other trade routes can take the place of pure trade in and out of China? The rising trade in the Far East with all the other Far Eastern companies, Vietnam, Philippines, Indonesia, all this is a significant place of activity and rising activity. India as well, which is continuing to grow at a fast pace. Africa is also a place which is growing. So there are pockets where we can see trade growing from. Is EuroDry going through Suez or diverting? We have not been asked to take by any of our charterers to pass the Suez Canal during the last month, and we will see if there is such a requirement from any charterer, what we will do depending on the situation at the time. Are you planning to instruct your vessels to avoid its route via Red Sea? I answered that question just before. You may have addressed this, but please comment on capital allocation with respect to increasing the dividend, debt reduction, growth. Well, let me say that debt is at very low levels. We don't intend to eliminate debt. We think debt is an important thing to have on a balance sheet. It helps you have sufficient funds to invest. It costs us 5, 6, 7% the debt. We hope that we are making more than over a whole long period, right? Because shipping is very cyclical, but we hope that we are making a return on equity definitely in excess of 15% in the long run. So yes, we will keep having debt, but not much, because we are always wary of the fact that the market can go down. And as we managed as a company to weather the storms during the last decade and survive when it was very tough and many companies had to resort into excessive dilution of their shareholders, we didn't need to do it because we were relatively prudent on our debt. So debt we want, but we keep it at levels that we feel very safe. The remaining funds, we have to balance how we use them between growing the company, between paying dividends, and between buying back shares. Right now, we think that buying back shares and growing gradually the company are the two ways to invest our extra liquidity. Final question that I see here is, what determines your voyage expenses from quarter to quarter? The voyage expenses are always fixed voyage expenses. Typical voyage expenses are the bunker costs if you are on a voyage time charter, port costs. These are the main two things that you have when you're on a voyage charter. In a time charter, you have always the standard costs that the company has, which is their manning costs, their maintenance costs, the insurance costs, the repair budget. So this is pretty standard. I think that I have run out of the list. One final question. Do you have any operations contracts in Canada? We have traded to Canada on vessels on time charter. I don't think we have a specific vessel in Canada today, but we have traded to mainly the west coast of Canada quite a few times with our vessels. I think I've answered all the questions as best as I could and gave you a clear picture of our company. We are optimistic, as Tassos said, that the very limited supply of dry bulk vessels will help us have a very good market at some point in time when demand picks up. That really depends a lot on geopolitical considerations. But with a limited supply, we hope that we will at some point see a very good market. And with that, I will turn the table back to Nicholas Bornozis for his closing remarks. Thanks again, Nicholas, for the opportunity.
Before Nikos takes over, let me say thanks as well to both Nikos and to every participant who took the time to join us today.
Well, my time to say thank you to our participants, to Aristides and Tassos. And I have to say, great presentation. You got an avalanche of questions. I mean, really indicative of the interest in the sector and in your company. So thank you very much. In closing, to remind everybody that this webinar will be available for replay, for access upon demand on Capital Link's website, capitallinkwebinars.com, and on Capital Link's YouTube channel. And with that, we can all disconnect. And again, thank you very, very much.
Thanks again.
Thanks, bye.